Welcome back everybody to a new lesson. Today we're going to talk about stop losses and more specifically about how to apply stop losses. This is a question I'm getting lately quite a bit and I wanted to clarify it for you ladies and gents. So before we understand how to apply the stop loss exactly, what we need to understand the purpose of the stop loss, right? We need to understand, why do we need a stop loss? Some people can actually think to themselves, hey, why do I need a stop loss? I just put a trade and let it ride and whatever happens, woohoo, let's go, right? Something like that. Or let's fucking go, like, yeah, to the moon, whatever, all these, FOMO, crowd, sheep herd mentality, which we do not want to apply, all right? We actually want to use good tactics, good habits, good behaviors to make us consistently profitable. Now, there is an old adage in trading. Everyone heard about this probably. If you read at least a book or two or watched some videos, you probably know about how you need to cut your losses short, meaning get out of a losing trade fast. That is the concept of stop losses. So first, what is the purpose of a stop loss? And we need to define it. So the purpose of the stop loss, as the way I define it, is to get you out of a trade with a minimal loss prior to it potentially breaking lower even more, right? So what's the purpose of the stop loss? To protect you, to make sure that you get out of the trade with a small loss, because remember, losses work geometrically against you. If you lose 10%, you need 11% gain to get back the money you lost. If you lose 20%, you need 25%, right? If you lose 90%, you need 900% gain to get back to break even, right? So losses work geometrically against you, so you want the loss to be as minimal as possible. So this is the purpose, right, of a stop loss, to get you out with a minimal loss prior to potentially, because you don't know, all right, breaking lower even more, right? Very important concepts. Or perhaps to get you out of a trade that needs some more time to build. Sometimes happens quite often, all right? You get a small breakout of a pivot, of a base, whatever, and then it fails back down, kind of a fake out as we call it, right? And it just needs more time to build until it breaks out. Now, you don't want to be sitting in this trade for who knows how long until it builds enough of a base to really perk or go through that breakout again. Maybe it will take a few days and that's okay, but maybe it will take a few weeks or maybe a few months. So we don't want to be sitting in a trade. So stop loss should be to get you out of a trade that will fail, or to get you out of a trade that will potentially fail for a short term but will continue later, but you don't want to be sitting in it while it builds, because you will have other possibilities, other potentials, right? So this is the purpose of a stop loss. Now that we have understood, right, the purpose of a stop loss, which is to protect us, right? It's to protect. Just like you won't get on a car without an insurance, right? No, or without the brakes. That's even better. That's a better analogy. You won't get into a car if the brakes are not working, right? Easy. If the brakes are not working, I don't want to drive that car. So think of the stop loss, all right, as your protection, as your brakes. You want to get into the trade, the car in this analogy, all right, with brakes to make sure that if something goes bad, you can just get stopped out or, stop the car, all right, before it crashes and kills you, all right? So now that we understand this concept, we want to understand how to choose the correct spot, the correct area, all right, where to apply a stop loss. So let's understand this a little bit better. So now that we want to understand this, we need to understand the concept of where would it be. So let's define where would be, all right, the best area to apply a stop loss. So this is the definition, right? The stop loss should generally be a point where if we are stopped out, it means that the trade has failed, or as I said, needs more time. Remember the purpose? The purpose is to get you out of a trade that is failing, or to get you out of a trade that just needs more time, right? So you need to choose the price level. You need to choose the price level for the stop loss to make sense, all right, to make sense that if it triggers, that it either means, all right, more often than not, because we don't have any certainties, any trade can stop you out and continue actually your way. Any trade, anything. But again, you don't want to drive the car without the brakes, even if you don't crash, all right? You want the brakes. So the stop loss should generally be, all right, you need to apply to put it at a point where it makes sense that if you are stopped out, it means that the trade has failed, right? Or that the trade needs more time to build and you don't want to be sitting in it. Now, remember that too tight of stops can lead to being stopped out of a good trade that experience some volatility at the breakout. So for example, let's say you take a trade and you put the stop at 1% just because you don't want to lose more than 1%. I don't know why, right? You will get stopped out many times of good trades that just experience some volatility on the breakout, because sometimes on breakouts, sellers are coming and they try to sell with the good volume that usually follows or comes alongside a good breakout. So it can be insiders, it can be institution, doesn't matter. But sometimes there is some selling pressure that might arrive at the breakout that makes it fail for very short and then continue, all right? So remember that you want this stop loss to make sense. 1%, maybe it makes sense, maybe it does. Usually, more often than not, 1% for at least our style of trading, because other styles of trading, maybe they're very short term, maybe 1 minute charts, I don't know, right? But for our trading style, 1% usually will be really tight and it will stop you out of good trades. And actually 1% will usually not make sense in that matter that we said. Remember what we said. It needs to make sense that if you are stopped out, it means that more often than not, the trade has failed, right? Or just needs some more time. So with that in mind, remember, too tight can lead to being stopped out prematurely. Now that we understand the purpose and we understand the definition of a stop loss in my eyes, and we understand how to understand where we should apply the stop loss, we need to start understanding the technicals of how do we actually find the best place, the best area, the best price level to put it, to apply the stop loss, right? And we have a few ways to do that. So we want to use price action to determine the best level to achieve this goal, all right? Price action is king. Many people think that what I do with chart means technical analysis, right? Yes, you can call it technical analysis, but I like to call it price analysis, because on the charts, what we see, it's a visual representation of all, as we said, of all the actions and thoughts of all, the entire participants of the market, and you can see it on the chart, and you can see it in bars and volume of price. So what is this? This is actually price action. This is where people are willing to buy or sell. So we want to use the charts, we want to use the price action to help us determine where is that point where it most makes sense for us to put and apply that stop loss, that if it's triggered, we are actually out of a trade with a minimal loss of a trade that will more often than not, listen to me, more often than not fails or needs more time, all right? So we have a few ways to do this exactly. We have 4 ways that we want to have in mind, right? One, sometimes we use the daily low, right? And I will show in a second. A daily low is a bar on the daily, all right? Or whatever time frame that you use. I usually like to use the daily of the daily breakout. Once it breaks out, I want to put sometimes the stop below the daily bar candle, because from my studies, I noticed that the best trades, all right, usually when they break out, they never go below that daily breakout again. Sometimes they do, and it still continues, all right, but more often than not, they don't, right? Now, before I continue, I needed to say something else. For me, all right, and I should write it, right? I should write it down. For me, let me move the mic for just a second. For me, I want the least possible risk that makes sense, right? Sense. For me, I want the least possible risk that makes sense. For example, if I can have a 1% risk and it makes sense, right, price action wise, because it's below the daily low or whatever, I will do that, right? If it's 3%, I will do that. I will usually choose the tactic, all right, daily low, or the things that will go in just 1 second. I will use the tactic that allows me to have the least possible risk that makes sense for me to, if it stopped out, again, more often than not, it means that the trade has failed or that it needs more time, and it will not stop me out just because of sheer volatility, right? So very important concept. I want to have the least possible risk, meaning a risk is the percentage of where I was stopped out versus where I entered. 5%, 3%, 10%, or I have my rule of no more than 10%, for example. So daily low is one tactic. Pattern low, what is a pattern? A pattern low, patterns in this sense, all right, is not a cup and handle pattern or VCP pattern or bull flag, whatever. This means actually a pattern of candles. Sometimes we have inside days candles that can be considered a pivot that we have over here, but sometimes I prefer calling it a pattern because it's actually even tighter than the pivot itself. So pattern low, and I will show you exactly what this means in a second. Or I will use a pivot low. Remember that, and I will draw it. Sometimes we have, we have a base and we have a pattern, for example, a cup with handle, right? And the handle itself is a pivot, all right? So I'll put it below the low of the candle. So that will be the pivot low. And sometimes if the base is really tight, usually it's not, I will use it below the base. Because if the base itself is less than 10%, very tight, more often, usually this doesn't happen, you can actually use the base low. But many times you will see me either the daily low or the pivot low, sometimes pattern low, and very seldomly below the base low. So let's see how this looks like in me drawing it, right? So the daily low, and let me take now this and let me just choose red. This is red, perfect. So imagine you have one candle, right? Inside day candle, and breakout of these. This can be considered a pattern or a pivot, right? So I will put this is where we actually got in. This is the breakout of here. And I will put the stop loss below the daily low. Many times, all right, the daily low will be the least possible risk, all right? So the daily low usually has the least risk of these all. So many times you will see me use the daily low because the daily low will be the only risk actually with less than 10%, right? Because in crypto sometimes things are volatile. Think because crypto has many coins with very small price action, 0.00111. So movements are more volatile than something, let's say, of $13 or $20, for example, that movements percentage-wise are smaller, right? So a lot of the times I will use the daily low. So this is the daily low. What is a pattern low? Perfect. A pattern low is, let's say we have, we have a movement up and then we have an inside day and an inside day. So this would be a pattern, a candle pattern. Inside days, all right, is a pattern, all right, of candles, a candles pattern. So I will put the stop loss sum over here. Why? Because sometimes I will see that if this is the breakout, I will see that maybe this is only 1, 2, or 3%. And usually I don't like to put something that has below 5% risk actually, because anything below 5% is very, very tight and many times will stop me out before, it moves. So usually my stop loss will actually be 5%, between 5% and 10%, all right? That's my sweet spot. And I think my average overall after many trades is around 6%. That's my average stop loss, right? So this is a pattern low. You see, this is the pattern. This would be the breakout, the daily breakout low, just like over here. But this would be the pattern low. Now, a pivot low would be something like, let's say, all this, all right, is actually this, all right? This thing over here. So we have the breakout. I took the breakout over here, and I will put the stop loss below the pivot over here. Let's say this is it over here. This will be the breakout, and I will put the stop loss below the pivot. Again, I want it to be less than 10%, preferably around 5 or 6%, as I said. So this is the pivot low. Again, as you can see, the more we go to the right side, usually the bigger the risk is. But sometimes the daily low is 1%, the pattern low is 2-3%, so I'll use just a pivot low. And again, just remember that as you go from here to here, this actually makes more sense technically wise to put a stop, because if the daily low has stopped out, yes, it makes sense that maybe the trade needs some more time, but sometimes it will just mean that volatility took you out. All right, volatility took you out because it's a day low. Pattern lows is more substantial. Why? Because sometimes you have 1 or 2 or 3 or 4 or 5 days within a pattern. If you break below it, it means that you're breaking below a price level where it hasn't been traded for already 5 days prior to a breakout. So you broke out to a level of new local highs or new all-time highs, and then you go back below a level that you haven't traded for 1, 2, 3, or 4 days or something like that, right? So it's more substantial. And a pivot low, or imagine breaking out to new local highs or all-time highs, and then breaking down not below the daily low, not below the pattern low, but below the pivot low. That a pivot can be 5, 6, 7, maybe 10 days. So you break down below an area that hasn't been traded there for 10 days or something. That's more substantial. And the base is even longer, maybe 30, 40 days. It hasn't been traded below that area, right? So you can see that as you go to a more substantial area, it usually has more confirmation that the trade really has failed. And remember the purpose. The purpose of a stop loss is to get you stopped out of a trade that is about to fail or that needs more time, right? So choose from either of these. However, with the understanding, all right, that first of all you have the purpose, and right, that for me, all right, I want to choose the least possible risk that makes sense with the purpose, right? So base lows, many times, big risk, 15%, 20%, too big of a risk, I won't use it, right? Pivot lows, I will try to use the pivot low if it's between 5 and 10%, right? However, sometimes I don't have a pivot low, I have a pattern low in between these areas, right? And sometimes I only have the daily low because boom, it came from the low and it's just breaking out to the rooftop, okay? And we're gonna see examples soon. Now, sometimes, right, you won't have either of these below 10%. So if it's non-existence, the stop loss is neither, not the daily breakout, not the pivot breakout, pattern breakout, whatever, right? If it's non-existent in the percentage that you want to allow yourself, right? But you're still wanting or wishing to get into the trade, consider using a staggered stop. A staggered stop is where you use multiple stops, not only one. So let's say the breakout of the daily low, all right, is at 12% and you want to put it over there, but 12% is more than 10%. So you put half of the position, for example, at 6%, mid-air, for example, all right? Or you use a smaller time frame to put that stop loss before under, right, below a shorter time frame pivot. And then if you get stopped out of the 6% and you get stopped off as well the bigger, more substantial stop loss of 12%, then you average it down to roughly 9%, which is acceptable within the rules, all right? So, as I said, if non-existent within, the daily low, the pattern low, pivot low, or base low, but you still want in the trade for some reason, you've been watching the trade, you want to go in it, everything is sound, but the risk is too high, consider using a staggered stop, or, all right, all right, if the tightest stop, all right, to apply the stop loss bears too much risk, just consider it sign that the trade is too risky and to let go of the trade, right? Many times I will use the risk to signal me if I want even to go in the trade or not, because maybe this is too volatile of a trade and I don't even want to get into it. So what I will say to myself is, hey, the risk is too big. I'm not accepting the risk. I'm letting the trade go, and sometimes the trade will actually go higher, right? But we are not in the game of getting in all the trades. Yes, the best trades, yes. But we're not in the game of getting into everything. We are in the game of getting into the best trades with the least possible risk, right? Why? Because this is a good habit that will lead you in the long run, all right, to having profits made. But when you lose a lot. And when you make money, you make big money. If you will start being too wide with your stops, what will happen is that, yes, you will have sometimes opportunities to make money, but when you lose, you will lose big. and you will give a lot of your money back to the market, right? So consider, if there is no tight stop loss, no less than 10%, consider it sometimes as a sign to not take the trade. Remember, buying correctly solves most of your risk problems, all right, of your risk management problems, let's say. So this is it in a nutshell. Let's go over and see all of this in an example of a chart. And what's better to show you an example of one of the best trades we had in the past year of 2023. This is CAS prior to the breakout. This is November 3rd, just prior to the breakout day, which was November 4th, right? So I'm not going to go over the edge. We all know the edge. We have the up move, all right? Then we have the VCP base, all right? All of this can be considered as the VCP base. Some people will consider just this as the VCP base. Doesn't matter for me, right? Why? Because we had this fake out area, and we can say that after a fake out area you reset the base, and that is perfectly fine, right? But I don't want to go over this. I'm just re-illustrating. If you've never seen this, you can go to my CAS videos, but I just want to always reiterate our edge, just to make sure that I instill this in your mind, because it's really important. So this is the CAS trade. Now, what I have seen here, right, as I said, I saw the VCP, I saw everything I wanted in this trade. I really wanted in this trade. Why? Because this was the best chart in crypto I've seen in a while, and I have already made money in this coin earlier this year in March from this breakout over here, right? I made substantial profit from this breakout, right? Over almost 200% on this profit. And I knew from my videos on CAS as well that it has a lot of followers, a lot of hype. So I just wanted, I knew from everything that this has a high probability of a great trade. And not only that, I noticed that we had potentially a good area for low risk, right? For low risk. So we had a few areas where we could get in, right? And I will illustrate a few. This is the best area to enter, and this is a pattern, right? This is a pattern of candles. How? Let's zoom in. You can see that these candles, right, are inside this candle. This bar is bigger than this bar and bigger than this bar. So these two are considered inside days, and actually these three candles are within this candle over here as well, almost, not exactly. So these three candles are the pattern, right? This is the pattern, as I said. Now, these, all right, all of this can be considered the pivot low, right? This is the pivot over here. All of this can be considered the pivot, right? Because as I said, remember, this is kind of a cup in handle. Let me just illustrate it. This is the cup. This is the handle, and many times the handles, right, this part of the cup and handle is actually the pivot, right? And this can be considered the entire base. Now we don't have here still the daily low breakouts, but we'll have it in just 1 second. So now that we have this in, let's get in the trade, or let's put where we want to get in the trade. If you really want in the trade, you might want to buy the breakout of the pattern itself. So you can put a breakout over here, or maybe on the pivot breakout. This whole thing is a pivot, and you want to put the breakout of the high of this pivot, or maybe you want to get in the high of the last known local high of the base, and actually the entire chart. So you had three different areas where to have your entries, and for now you have two areas, good areas to put a stop loss below the pattern, right? This is the pattern, below the pivot, and of course you had the below the base, but as you can see, this is not valid because the risk is too high, right? So let's take our measurement, and let's say from here, right, from this all the way to over here, this is the 5% risk on the patterns, okay? So the pattern, so if you put a stop below the pattern, right, the pattern of these inside days, and if it breaks out in the fourth, so you had 1, 2, 3, 4 days that you haven't traded below this area. So it's kind of substantial. If it breaks below it, means that it goes down to something that hasn't been traded in this area for a few days, right, below this. So you have 5%. Or let's say you go below the pivot, That's 8%, very much acceptable. Still, you can put the stop below the pivot if you want to. Maybe use stagger stop, maybe half below the pattern, half below the pivot, perfectly fine. Now, if you go all the way to below the base, that's 22%, not worth the risk at all. That's why I said this is a big no-no. However, this is 5%, very acceptable. This should be a V. Or 8% acceptable V as well, or staggered stop if you want to. That's a very valid tactic. Now maybe you got in at the pivot breakout, which was the first entry on on our group. So this would be 6.35% below the pattern, or 9.68%. So still very valid in both areas. Again, you can use staggered stop if you want to minimize. Either way, these two are good. However, if you go and you buy the breakout of last local high, then this is 7.8%, but this is 11%. So yes, the first one is valid, but the second one isn't valid unless you put half on this, as I said, staggered stop, and half over here, and then the average is lower, so you can use these two from the breakout here as well. Now let's add one last thing that we don't have over here, and that's the breakout of that's the low of the breakout day. So let's move just one. All right. So this is the breakout day. You can see that we broke out 1, 2, 3, either levels, all right? The pattern, the pivot, and actually the base high, and this was the all-time high too. We broke everything. And this is where you had potentially could have added the stop loss over here. Let's measure it. If you use the pattern breakout, this would be 0.8%. So very, very, very tight. Too tight, in my opinion. If you use the pivot breakout, then you have 2.5%, very, very tight as well. If you use the breakout of all-time high or the base high, then you had 4%. Then it will make sense. You can see how it depends on where you got in, all right, as well, to figure out where to put your stop loss. Why? Because as I said, for me, all right, my tactics, my rules, the way I trade, all right, I want to put the stop loss, again, to fit the purpose of when I get stopped out, it will make sense, all right, it makes sense, but as well to have the least possible risk, all right, least possible risk. So yes, if I bought the breakout of all-time high of base high, this makes sense, and of course, you can use the pivot as well, it still makes sense. The pattern makes sense. The pivot doesn't make sense anymore at 11% unless you use a staggered stop again, all right? Staggered stop, as we said. So, beautiful. Now you understand everything just by showing this example. And of course, CAS went from 0.05 to 0.15. So it made 3 times on our money. This was a beautiful trade. This is a beautiful chart. And I hope this helps you understand and illustrate how do I think, all right, on where to put the stop loss. Again, I combine the purpose of the stop loss, right, where I want to be stopped out at a logical area that makes sense, that if I'm stopped out, it means the trade has failed or needs more time to build. That's A, all right? And secondly, I want to combine that with my wish to have the least possible risk on each trade. Why? Because I know that losses work geometrically against me and I want to go out the least possible risk, usually between 5 and 10%, because below 5 can be a bit too tight. And I use different tactics, all right? Daily low, the day of the breakout low, all right? Pattern low, pivot low, or base low to help me determine price action levels. Where is the most suitable price level, right, to put the stop loss that makes sense for me with what I've told you so far. All right, everyone, hope you liked what I had to say. This is a very, very, very important lesson and you can learn a lot of it. And I know that you might understand now that this is not an exact science. Trading is not an exact science. This is not math. There's a lot of art, all right? There's a lot of art in trading, right? But as I tell to people that I work closely with and I coach in the Pro Trader or Top Trader, you have your rules and principles, all right, and strategy that are boundaries. You don't break them. For example, I don't take more than 10% loss on a trade, right? That's a rule, right? However, you have the tactics that give you that art part, all right? They give you that area where you have some more flexibility to use different tactics to help you. Is it the daily breakout low, the pattern low, the pivot low, the base low? You will need to decide with the help of your mind, wit, needs, risk, comfort, and so on and so forth, to make sure that over the long run, when you get stopped out, it will mean more often than not always, because nothing is certain. More often than not, when you get stopped out, it means, all right, and you probably know this by far, if you got stopped out, it will mean more often than not that the trade has failed, or that it just needs more time to build and you don't want to be sitting out when it does. All right, everyone, hope you enjoyed this. Stay tight, and until next time, no edge, no trade. Cheers, everybody.